They're buying a house in North Kildonan. It's a disaster. They thought the bank would sit up or spike up and say, yeah, okay, let's do it. No, they couldn't do it. And they have a tight crunch for getting the financing in place. The common sense aspect of lending has been taken over by what the computer says. So the private side has really started to grow. I think this year marks my 35th year in the mortgage business. So I had a choice to make, and that choice was, do I try delving into the mortgage business on the institutional side, or do I try the broker side?
Define soft hit versus hard hit.
So soft hit is more so the lender might already have some information from you, and they'll do a background hit, which will typically not show up as an inquiry on a credit bureau like it normally would if you went to lender A, lender B, lender C.
Real estate investor.
Yes.
Either fix and flipper or a burr person, buy and hold. What is your best advice for them to, before they approach private lending, to be successful?
They probably need a really good handle on...
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? I do these podcasts as a passion project, and the only thing I'm going to ask of you is just to subscribe to it, because that helps grow and helps put it in front of other people. So if you haven't already, please hit the subscribe button, and let's get back to the show. Dennis, welcome to my podcast.
Thanks for having me.
So I've always wanted to have on my podcast somebody in the mortgage space to speak about private investments, private mortgages. But before we do that, why don't you tell the audience a little bit about yourself and your background?
This year marks my 35th year in the mortgage business. I started back in 1989 on the lending side. I was with a couple of different trust companies. And then in the early 90s, there was a situation that took place. Real estate was going a little bit sideways. And financial institutions, there used to be something like 25 trust companies that got whittled down to about 4 in a matter of about 3 to 5 years.
Wow.
I saw the writing on the wall, and part of the business that we generated with the trust company came from real estate agents, developers, and there was very, very few brokers that were in our space. I could probably count on one hand how many brokers there were in that space. And then I knew I was going to be getting let go, because high man on the totem pole, you're always going to be the one let go first. So I had a choice to make, and that choice was, do I try delving into the mortgage business on the institutional side, or do I try the broker side? And a friend of mine who used to be the director of mortgages for Investors Group said to me, I'd like you to come and work with me at a salary of $62,000 a year. And I told him, and I was pretty blunt when I said it, I said, you know what, I'm going to give this a try on the broker side, because again, there's nobody in that space. So I delved into it. I started out as an individual person back November the 5th, 1993. And I started a company, brought on a partner in 1995. That partnership didn't work out the greatest. In 96, I went by myself again, and I've been growing ever since. But in that same period of time, the mortgage brokerage market started to pick up quite a bit. And with that happening, we've gone from maybe 10 agents back in the early 90s to today there's over 300 agents in the province of Manitoba.
Wow.
So it's grown quite a bit, but it's been a lot of fun. Definitely been a lot of fun. We've got a national association called Mortgage Professionals Canada. When it first started in 1996, I was on the board of directors for the province of Manitoba for 7 years, and it was time to pass it on to a couple other people. And over time, up until about 2 years ago, I'm in my third year now, I came back onto the board again. And it's a tremendous opportunity for those who get the chance to do it, because for me, what I found was it connected me with a lot of people nationwide. It helped me understand real estate transactions and mortgage transactions right across Canada. And it turned around, and it also gave me the ability to meet a lot of different people at the senior level of the financial institutions that are out there. So you got to put a name to a face. They got to talk to you. They got to understand what your province was all about, whether it was foreclosing or underwriting or administering or anything like that. So it's been a terrific journey, and we're having just a blast doing it.
Wow. No, you and I go back like a long way.
Quite a while.
Quite a while. Yeah, we've done some stuff together, but I didn't really know the origin story there. Can you explain for the audience, like you said, you could have chosen to go the institutional way or the broker way. Maybe dissect that a little bit.
So going the institutional way, I mean, I'd already created or set myself up to meet a lot of people, both on the insurance, like the life insurance side, because a lot of life insurance companies own trust companies. So I got to meet a lot of financial planners. With Sun Life Trust, who I was with, they were at the time part owner of Century 21. So we made a relationship, or we had a relationship with a lot of the people at Century 21. And then it just came down to, do I want to continue on in that world? Did I find it exciting enough? Or do I want to go work for a financial institution like Investors Group or TD Bank or IBC and be one of their players into that market? There's limitations of product when you're dealing with one specific institution. The broker market was kind of neat because you got to get an idea as to who was doing what. And I've always been one of these people who wants to try and make a deal work as long as it makes sense. So the broker market just naturally tended for it was a tendency for me to just naturally go there just because it made the most sense for me. I like making deals happen. If it's the right thing, great. But the interesting thing about it is you get to learn a lot of different things about a lot of different people and who can do what and who's full of BS and who's got dreams. And then you try and bring them down to reality to make them understand that's not how it works. And then it's an education thing, and I'm big on education.
Okay. So when you say institution, I get, the big banks, right? Some credit unions, and then you have somebody who will get a mortgage for you, but typically, I mean, it's with that institution. I've used brokers before, and you can tap into those markets and others, right?
That's correct. So what ends up happening in the mortgage world is we have what's called monoline lenders. And monoline stands for one. Mono is one and one line. So all they do is mortgages. They're not going to delve into doing, most of them won't delve into doing lines of credit, credit cards, banking, deposits, RSPs, GICs, anything like that. All they do is mortgages.
Okay.
So what they do is they go out in the market and they'll set up arrangements with different financial institutions or pension funds or insurance companies or stuff like that. And they'll say, we're going to borrow X amount of dollars from you and we're going to put it out underneath our name. It's almost like a white label product. We'll put it out in our name. We'll administer all the funds and we'll pay you a spread for letting us use this money. There's a lot of regulations that go into place like that, but they will a lot of times have different kinds of byproducts that go with it. So you'll have your straight A conventional deep discounted rates because they can do that kind of stuff. And then they'll have a different investor for something that might be a little bit more riskier. And then they'll have criteria for it, whether it's a stated income deal or an equity deal, or there's different parameters that they have to follow.
Okay.
So we've got access to all kinds in the broker market. There's access to all kinds of different lenders, probably 30 to 50 lenders that are, I'll call them institutional, whether it's the banks or the credit unions or the monolines.
Okay.
There's probably 30 to 50 lenders that are out there that we can play with. And that doesn't include any of the private stuff because there's a lot of different private lenders that are out there.
So you mentioned trust companies. What's a trust company?
A trust company is regulated by the Bank Act, and they fall into the same situation as what a bank would do. It's just that they've got a couple of different criteria that fits into there that a lot of the banks don't want to play with, and that is administer trust estates and trust funds on behalf of individuals and corporations. For the most part, they're no different than a bank. They've just got these additional little quirks that allow for them to be able to get in and administer estates for people. What else would they do? They'll lend out money. They do have deposits. They do have different kinds of banking facilities, but nowadays you hardly ever hear of them in the forefront. There used to be 13 branches downtown, corner Portage and Main. I don't think there's one today.
As a mortgage professional, you've got all these different types of products. And as a broker, how would you say, is there anything different on the service level side as opposed to working with somebody in a bank?
So it's an interesting question. It's an interesting concept. Traditionally, the people who work in the bank, so I'll call mortgage specialists working for the bank, they're doing the same thing that we are, except that they've got one product to sell, and that's the bank product. And if the bank supervisor says, no, they can't do the deal, then they wash their hands of it and they can't do anything more with it. In the broker world, what ends up happening is we've got access to, like I said, 30 to 50 different lenders that we can play with. And you've got an idea. Most people who've been in this business for a while have a pretty good idea as to which lender is going to be the best one to suit with that particular customer. In the broker world as well, it comes down to they take a look at how they get compensated. And this is part of the thing that irks me in our world. And that is they think of their pocket first. I've got a company
Not the
that's
customer first.
They don't think necessarily the customer first, but they've established really good relationships with people. But you have to be able to explore and explain to the customer why Scotiabank might be better than TD Bank, might be better than Merrick's, might be better than First National or anything like that. And like I said earlier, I like the education component to it. You have to factor in a number of things. It could be something like payments, prepayments, prepayment penalties. That's getting to be a big thing, and it's going to be another big thing moving forward. Just understanding all the different products that are there. So the education component of it is a big thing. With the bank, again, they only know the one product. In the broker world, you have to get a really good handle on what's taking place and how these different products will affect the individuals. And if they think the way that they should, and that is with their head and not their pocketbook, then they know that the customer is going to be put in a very, very good place. We don't make the mortgage payments. We just suggest to the borrower, here's the options that you have available. Which one do you think is going to be best for you? Right. And that goes a long way. And you'll find that a lot of the established mortgage brokers in the industry across Canada will typically think that way. It's customer first.
You know, a thought just popped into my head because I'm a real estate investor. And I remember in the early days, it was tough to get a mortgage. Like I started in the, late 90s.
Right.
So you couldn't get insurance.
Yes.
And nobody wanted to write any kind of mortgage on red zone properties and all that kind of stuff. But my point, I remember going to different financial institutions and each one would check my credit. And if their product wasn't good for me, then I'd have to move to the next one. All of a sudden, my credit started to take a hit. I'm putting words in your mouth, but if you're with a broker, is there just one credit check?
In most cases, yes, not always. So what ends up happening is the institutions reserve the right to pull a credit bureau after they've seen the deal. And the reason why they do that is to ensure there's been a lot of things that have gone on in our industry over all of these years. And technology is one of the big players in there. So you've got a lot of people that will create fraudulent documents as far as income, down payments.
Yep.
They play with PDF files for appraisals. So they're starting to play a lot with that kind of stuff. But the interesting thing is when you start playing with the credit bureau, because in the past you used to fax these things out, and I'm dating myself when I say that. They would fax these things out. They'd use whiteout and stuff like that. The good thing about technology is it gets sent to them automatically. So typically, if the credit bureau is pulled within the last 30 days, most lenders are okay with it. If it's past 30 days, they want another one that's going to take place. It also shows a habit. Sometimes, to your point, what you just said, how do I know that Garrett didn't get an approval at company A and then another approval at company B and another approval at company C? And then there's a game that starts to get played.
Right.
So that's part of the reason why it's better to go to the broker side, because the broker will typically pull one credit bureau, which is usually accepted by all of the lenders that are out there, if it's usually within 30 days. And it's really interesting because now you're starting to see different technology kicking in again, and you see companies like Equifax that start playing with the algorithms. So nowadays, those multiple hits aren't necessarily as bad as they used to be, because they'll take a look at it as being a soft hit, and the soft hit doesn't impact your credit score as badly.
Okay.
So that's getting to be something that's getting to be pretty popular.
Define soft hit versus hard hit.
So soft hit is more so the lender might already have some information from you, and they'll do a background hit, which will typically not show up as an inquiry on a credit bureau like it normally would if you went to lender A, lender B, lender C.
Okay.
Because they're all going to do that full physical hit, and you'll see it. Again, when there's multiple hits taking place, it's no different than when people go to buy cars. They might have 10 inquiries inside of 2 weeks. it's not going to be as bad as they think it is because people know there's all kinds of options that are out there.
Okay.
And Equifax has adjusted their algorithms to not have as much of a negative impact on the credit bureau score.
So they're basically putting a real life perspective on it of what the journey is of somebody trying to buy an asset, purchase an asset, lease out a car.
Correct.
Instead of just looking like a credit seeker.
Correct.
Okay.
Very true.
What about, I mean, we'll see where the podcast goes here, but I'm thinking now, okay, appraisals. How is that different when you're with a broker versus a lending institution?
So there's really no difference. Lenders, if you're working within a bank, I'll pick on RBC because they don't like dealing with brokers. But RBC has their set of appraisers that they're going to use, and that's all that they will use. When you get outside of or in the broker market, there are times that we have the same possibilities available to us, but now they've got different, I think there's about 4 or 5 different companies that are out there that are blanket appraisal originators, I'll call them. So I'll think of one right now. It's called Nationwide Appraisal Services. Lenders want to have this come in because it's independent and independently run. We put in a request to them and then they'll farm it out. They'll send out a note and say, who wants to take this one and what kind of cost do you have associated with it? Everything filters from the appraiser right back through NAS, and NAS sends us a copy of the appraisal. So it's independent. It helps out a lot with the monoline lenders, because for them, part of the criteria that there's going to be for the investor side of it is going to be, we want to have somebody independent, not somebody who's one of your appraisers, to go out. And then this way here, we have something to fall back on and know that it's not being rigged.
Right.
So they like that kind of side of it. The other thing that they typically will go for is title insurance. So they have particular criteria that's associated with them lending out the money.
So you said rigged. Again, real estate space, there's a lot of funny business that goes on, and we're not going to go there. But I mean, really, let's dive into that for a second, because when you have an appraiser that could be in the pocket of the lender and the mortgage broker, and they just want to get the deal done, I have seen this where the value comes in almost exactly as what you're looking for. Is that the type of thing you're talking about?
No. There's some that
inflating it, or
there are some that are going to be they will inflate it. There are some that are going to be a lot more conservative. There are some lenders who prefer to have lenders, we call them lenders appraisers, because there are some people who are out there on the appraisal side that when you look at their report, you feel like you've walked through the house. They'll give you the pictures. They'll tell you the sizes and dimensions. They'll tell you whether there was knob and tube in there, how old the roof is, how old the hot water tank and furnace is. Like, you get a really, really good feel as if you've walked through there. And then you take a look at the comparisons that they've given you. And do those comparisons that they're using make sense? Are they using correct numbers when it comes time to making comparisons for their adjustments? Those are really good examples of when when you're dealing with a really good appraiser, and they've built themselves up right across Canada. So I know that when a lender's coming into Winnipeg to start up brand new, they get asked, okay, who's the appraisers that will follow our guidelines? We want to have this, we want to have that. They might say something where any of your comps can't be any more than 60 days old, which makes it a little bit tougher. Your comps have to be within, say, 3 miles of the subject property, not 30 miles from the subject property. I mean, a property in South Point is going to be worth a lot different than a property in East St. Paul or Selkirk or anything like that. So some people try and get away with it. Most of them don't. So there's a lot of really cool things to look at. And then I've never been afraid to phone an appraiser and ask the question, like, why are you using this property that's way, way out of the market? They're on the other side of the river when we're supposed to be on this side of the river. Like, you can't do that. It's not a good comp.
And is that well received?
No, it's never well received. But then I tell them, I said, listen, we need to have something in the area, because you have to understand that if the lender takes back the property, they need to be comfortable that the comps that are there have been the proper ones that have been used. You just can't do that properly unless you have that conversation with somebody.
Well, there's the voice of experience talking. No, that's amazing. I want to segue a little bit into I'll call it the mysterious world of private lending. And the reason for
Right.
that is I'm a real estate investor. I've just more recently started using private. I like my 45 buildings that I've bought over my career have all been very traditional. I have used mortgage brokers, but I haven't ever done private except for the last few years. So why don't you, from a very 10,000 foot view, explain for the audience what private lending is in the real estate space?
So private lending is a really neat experience that's continuously evolving. And it's evolving because of all the changes that have taken place over probably the last 10 years, maybe more so over the last 8 years, when the government decided to make some changes to what traditional lenders could do or couldn't do. In the past, and I'm going to date myself when I say this, but I mean, I remember doing financing, 0% down payment, a 7% insurance fee, and 40-year amortizations. God, we wish those days would be back today.
2007.
Like, you really wish those days were here, but they're not. 35-year amortizations, 30-year amortizations, which are here. There's talk of 35-year amortizations coming back, but who knows? So the evolvement and adaptation of the private world has always been kind of neat, because they take a look at it on the basis of what is it that we can do in order to be able to make a transaction take place and eventually happen to have a payout. Typically with private lending, you're always looking for a payout and you're always looking for an exit strategy. So I get business from a lot of brokers here in Winnipeg. And one of the very first questions I ask them is, what's your exit strategy? If you don't have an exit strategy, don't talk to me, because I don't want to hold on to a property for an extended period of time. We have, by accident or by fluke or just by bad luck on the individual side. But it's really kind of neat, because bad things happen to good people. Unfortunately, life happens. There's situations where the government has come in and said, we don't like stated income deals anymore. And yet, people have the opportunity to buy a property at a really, really good price. They're hoping their bank is going to say yes because they've been there for 25 years. And the bank all of a sudden says no. I mean, I had one just last week I committed to. They've got tons and tons of equity in their house in North Kildonan. They're buying a house in North Kildonan. It's a disaster. They thought the bank would sit up or spike up and say, yeah, okay, let's do it. No, they couldn't do it. And they have a tight crunch for getting the financing in place because possession is April the 8th. There's no lender that was going to touch this deal institutionally. Mm-hmm. So we ended up getting the mortgage done. We put a mortgage over both properties and we're proceeding with the deal. The deal was instructed on Friday. So those are the kinds of situations that we'll run into. But even in the past, that wouldn't have been done institutionally unless you had the good gut feel lenders that used to be in place when the branch managers and assistant managers used to make those calls. The odd time you might get a credit union to say yes to that, but very, very odd. That those people, you can't find them anymore, unfortunately.
They want to dot their I's and cross their T's and cover their butts.
The common sense aspect of lending has been taken over by what the computer says.
Yeah.
Unfortunately. So the private side has really started to grow because you got a lot of people who have been in the lending field who understand what that experience is all about. And unfortunately, every so often, you're going to hit some that you eventually have to foreclose on or you have to take action on. It's just going to happen.
Yeah.
It's a part of life.
Okay. So when you say long-term, short-term, what do you, define that in terms of your definitions?
So short-term would be a year.
Okay.
Like typically we'll get guys who, I love the ones who come up to us and say, we only need the money for 2 months or 3 months. I already know it's going to be a minimum of 4, if not 8. Very, very rarely have I done a deal where they've stuck to the model.
It's pretty tough. I'm assuming like if you're even flipping, like to be able to flip something 3-4 months and close and get your money.
Yes.
It's pretty tough.
It's really tough.
Yeah.
Really tough.
It's not realistic.
No, it's not. But having been doing it for as long as we have, we've got a fairly good idea as to who is good at the practices of doing the stuff they're doing. Part of the dilemmas that they run into and the challenges they run into is if let's say they're doing a multifamily project and they expect that they're going to be getting taken out on the refinance after all the renovations are done. In the past, it used to go a lot faster. Nowadays, if they're following some of the guidelines and the insurer guidelines like CMHC,
waiting for a certificate forever and ever
and that could take 6 months, it could take 8 months, it could take a year. And that's unfortunate. So what their plan was to get out of it, and ends up costing them a little bit more money. In the long run, it's a better situation for them to be in. It's taken that much longer, unfortunately.
Okay. Now, when you say costing them a little bit more money, let's define that, because, I mean, private lending, there is an expectation you're paying more interest, right?
Yeah, usually you're starting off double-digit rates
Yeah.
to be able to go into there. And if for each month that goes by, and I like using 12% because it's 1% a month, makes it easy. So you know that every month, if you have a $500,000 balance out there, it's costing you $5,000 a month in interest. And if it's going to take you an extra 6 months, well, that's $30,000. Versus if you can get long-term money today at 5%, that's quite a bit different.
Yeah.
That's probably $2,000 a month difference of after-tax dollars that's not going into your pocket.
So what would you say to somebody that says, what gives you the right to charge that much, or not you, but private lending versus the big banks?
There's not a lot of options available to them.
Yeah.
You can go ask family and friends, see if they want to go in with you on an agreement of sorts or a partnership basis, and hope that they're ready to put up the money and trust you to be able to get the work done. But again, life happens. I know I've had people who have come up to me and say, I'm going to buy this house for X, do all the work myself and get it taken care of. 3 weeks into it, we had one where the guy fell off the roof and broke his neck.
Ooh.
So he thought he'd be in and out of this thing in 3 months. Well, it took 2 years to get it done. Not a happy situation for them to be into.
Right.
But unfortunately, that's what takes place. And you have to have that backup plan in place to be able to do it. And that's part of the education process, is you let people know what happens if this happens, what happens if that happens. In the background, we've got an idea and we do kind of an internal analysis. If they say it's costing them $100 a foot to get everything taken care of, we know they're out to lunch. It's probably closer to $200 a foot. So we kind of we take their budget and we match up accordingly and say, yeah, okay, you're on site, or no, you're not. And then every so often we'll take a look at the projects, with the ones that are doing the buy, fix, and flip. And we'll go take a look to see the quality of work that's being done. Your vision of what is a really good project versus my vision of what a really good project is are going to be different than everybody else's that are out there. There are some that are really, really good, and there are some that are just, let's slap it together, fix it up, and get out of here.
Well, and that must concern you as a lender, because at the end of the day, if they default, now you've got things that are, they say lipstick on a pig or whatever, right? And the bones are hidden, water defects, cracked foundations with drywall over them.
Yeah. And you know what? It's not targeting anybody, because there are good contractors that get caught in these things.
Yeah.
And there are some stuff that the surprises happen. City of Winnipeg comes in and they say, well, you can't do this or you can't do that. And they're halfway done the projects. And they were under the impression that they were able to, because they spoke to John, or because they spoke to Peter, who was able to get away with it. They always forget about that kind of stuff.
Yeah, I've got a secondary suite conversion on the go right now, and I'm 4 months behind because I haven't got my DP, my development permit from the city.
Right.
And unlike some of my competitors out there who, everybody knows, let's just start the demolishing. Let's just start this. Well, if I don't get my DP, then I'm just going to, renovate this as a single family home.
Right.
If I get my DP, then fine, I will start the demo, and I'm going to be spending a lot more money, but like you have to be pragmatic about it. Mm-hmm. I don't want to have to open walls if, later when I don't have a permit. I've been through that with rogue contractors. It's not a good situation.
No, it's not. And then there's also the carrying costs for that period of time that most people never count on.
Yeah. So let's talk about that, because I have rather enjoyed my brief, dip into the pool, so to speak, of private lending. It's worked really, really well for me. It's fast. They like my work. And I find that the more credibility I have, the faster the deal seems to get approved. Would you say that, like they talk about the 5 C's of credit, but one of them being credibility?
Right.
You just said it yourself. If somebody's out to lunch thinking they're going to do it for $100 a square foot, what does that tell you about the credibility of the person? the group?
It's a situation where before you advance the funds, you sit down and you talk to them. And before you issue a commitment, you sit down and you talk to them and say, why is it that it's like that? Why do you think it's that easy? Prove it to me that you think it's going to be that easy. This one that I just mentioned to you, I had to get them to rejig their numbers because they came to me and they said, well, it's going to be $20,000 worth of renos. This is a 900 square foot bungalow. The walls had mold all around the bottom. You can tell there was some damage of water in the basement. Like, this isn't $20,000. Like,
60
not
to
even
80K for sure.
Exactly. So they came back with a revised budget. With the revised budget, they did make it very clear we do already have all of the drywall available. They do already have extra doors that they're going to be putting in there. So they had some material that made it look good. I also had to make them aware of the fact that they had to change the electrical because I think it only had one box. It was a four fuse box, 60 watt panel.
Big.
Oh man! So I told them, I said, get ready because it's going to probably cost you about $10,000, not the $1,500 you're thinking of, because not any of the three parties involved are electricians. And I said, you have to hope there's no knob and tube, because you're not going to be able to get insurance. Now, the positive side for me is I had a house, their principal residence, with a lot of equity. That goes a long way, because when you've got a lot of equity in the house, they're not going to put that at risk. They're going to do whatever it is that's going to be necessary to get the house taken care of and make sure that it's fixed properly so that they can either refinance it, rent it out, or sell it off.
Right. Because you need to know your backup plans when you're looking at these deals.
Yes. Yep.
You're trying to be creative. Let's take a slight step back. I've heard the term A lender, B lender, C lender. Do you want to maybe define that for the audience?
So A lender would be typically your banks and monoline lenders. You see rates advertised on the internet. They say today you can get 5-year money at 4.49%. The qualifier that goes with that, it's got to be a CMHC or an insured mortgage, usually less than 20% down, or more than 35% down. Those will be typically your A lenders, and with A lender rates. Your B lender are the ones that fit a little bit outside of that. So you've got people, I'll use a real estate salesperson. You know, they make a lot of money, but they write off a lot of money. They've got all kinds of expenses associated with it.
And they're self-employed.
So probably the self-employed route is probably the better terminology we could use. So you'll have some people who will do what's called stated income mortgages, some of these lenders, but it's got to be within reason. So a good example of that might be a financial planner or a real estate agent. So they know that they've gotten X amount of dollars per year. What's a realistic expense list that they're going to have associated with that income? And then what's the net income that's going to be left there in order to service the debt? The fun part about that is it's a creative side, but it's a realistic side. We know nobody likes paying taxes. We just don't like paying taxes. So somebody who's making $150,000 a year showing $20,000 for net income for taxes, there's a lot of fluff in there, whether it's cars being written off, gas being written off, the house expenses, depreciation, all that kind of stuff. Most lenders won't recognize it that way because they have to go off of your notice of assessment.
Sure.
The stated income deal will just take a look at it and say, hey, I'm making this kind of money. I'm paying my buddy contractors cash, or I'm paying these contractors a little bit without the GST component on it. I don't want to pay the GST, so I'm not going to declare all that income. It gets to be interesting. So that's going to be kind of your B lenders, or the alternative lenders.
People who can read between the lines, so to speak.
Kind of, yeah.
And what types of institutions are these?
So companies that fit into there are name brand companies. There's like Home Trust as a company, First National, EQ Bank, Equitable Bank, Haven Tree Bank, RFA Bank. So these are ones that part of their mandate and their existence is tied into that alternative lending side. Optimum Bank, which is owned by Canadian Western Bank, they all have these kinds of programs, which to some degree have some common sense. But what's common sense to you may be different to me, can be different to the underwriters and so on. So it's a matter of justifying why this deal makes a lot of sense and creating the credibility for the individuals that are there. And typically a lot of that is going to be tied to their credit score. They'll take a look at the asset base that's in place. They'll take a look at the industry because they do have industry knowledges, all that kind of stuff. And they'll make that there. Another part that fits in is equity lending. And there's a couple of equity lending would be a situation where there's some of the banks that will go off of people who don't have a lot of income, but they got tremendous amount of investments and assets and not the cash flow to be able to be in place to be able to service the debt. So as an example, you might have somebody who's 60 years of age, now retired, collecting CPP and a small pension. They got a $500,000 house and they want $200,000 because they want to go on a 6-month trip, and their house is free and clear, and they've got good credit, but they can't service a $200,000 mortgage. So at the end of the day, you've got a couple lenders that'll sit back and say, well, you know what? We know you have the equity that's in here. You've got all of these scores that fit into play. We'll lend you the $200,000. And typically they're still within reason of interest rates. They'll be close to what it is that you could get on the A side, if not some of them on the A side.
Okay. I'm assuming the B lenders, though, comes at a cost.
B lenders come at a cost, and typically what they're going to do is they're going to charge a 1% lender fee.
Okay.
And their rates are going to usually be right around the bank posted rates or slightly higher.
So no discounts.
No discounts on any of those.
Okay. So if somebody's getting 4.5, 5 today with an A lender, B lender would be?
They'd probably be around high 6s, low 7s. Okay. And that would be for anywhere. Typically, they don't go any more than 3-year terms. So it might be for 1-year term, 2-year term, or 3-year term.
And why is that?
The period of time that they're playing the market game. We want to be out of this over a period of time. And the other side of it is that, get back to what I said earlier, you're doing your planning. A hiccup happened. We can get them out of that deal in a year from now.
Right.
We just have to hope there's no changes in the mortgage industry that's going to cause that to not go the right way.
Okay. So that's A and B. And then C lenders would be?
C is going to be your private lenders.
Okay.
They're the ones who just take a look. There's all kinds of parameters around private lending. There's things in the private lending space that I don't like, and that's how some people are convinced to do 100% lending. I mean, at the end of the day, if that borrower doesn't have any skin in the game, why should I put money into it?
Right.
Because I'm going to lose, they're not. No matter what agreement it's in place, if they're not losing, they're not losing.
So private lending, I mean, I have heard of promissory notes, not necessarily mortgages, straight out loans for construction. Is that what you're talking about? Or are you referring to traditional, like we're putting a mortgage in place and I'm backed by private money?
Putting a mortgage in place backed with private money.
So the proper way. I don't want to say proper. That's not nice. But
it's the correct way to do it.
Okay.
The safe way to do it.
Well, the safe way for if you're going to protect your investor.
Yeah.
Oh, so explain how you structure something like that.
So we get an appraisal on most of our properties. We will typically take a look at the marketability of the property today versus after the work is going to be completed. A lot of the rules that we apply are no different than what the banks will use. Like we won't typically go over 80%. There are some people who will, and that's on them. If they're comfortable with it, good for them. My experience has shown lending privately, going 80% is probably a bit at the maximum level to do that kind of stuff. Because I'll use this as an example. If somebody buys a property for $200,000 and they want 80% financing, I know the day they take possession, they're ripping it apart. So that property is not worth $200,000 anymore.
Fair, yeah.
I'm at risk.
Yeah.
And investor funds are at risk. So we got to make sure that that gets taken care of all the way through. This is where we do a lot of the vetting, making sure that they do have the connections, the credits. If you've got a credit score that's in the 400 range and you owe Revenue Canada all kinds of money and the Court of King's Bench shows that you got a whole bunch of charges against you, probably not going to happen.
Right.
Probably not. But when you take a look at the deals and you say, okay, I'll lend up to 75% against that. Again, the first question that comes out, whether I'm talking to the individual or a broker, what's my exit strategy? How are you going to get me out of this? And if you can't do it, then tell me. Because if you can't do it, I'm not your your guide to solve this problem. I don't want that problem. And then at the end of the term, we'll phone the broker and let them know that, hey, the mortgage has been paid as agreed. Can you turn around and go make some money? So now we become broker friendly.
Right.
Even though I'm in the broker space and I'm a private lender, I'm not stepping on their toes because they know that I'm giving them the heads up, say, hey, you got a chance to go out and make some more money again. You can move them into that A space or that semi-private space or alternative space. And then they get a really true appreciation. When payments come in NSF, I'll phone the broker and say, hey, this guy missed the payment. Do you know what's going on? Because they stay in touch.
Okay.
Like most brokers will stay in touch with
Sure.
the customers. The customers will want to stay in touch just to say, is there a way you can help me? Or I ran into this or I ran into that. Again, life happens.
Yeah. So flexibility.
Yeah, the flexibility is there. And then you find out from the broker, and you can really tell the good brokers in this case that they've got CRM programs that are in place. And you phone them up and say, hey, now's the time. Are you okay with taking it out? Follow up with them and find out.
Okay.
So it gets to be kind of neat to deal with that. But we still will try and maintain some communication with the customer and say, hey, you know what? You talked about this, you talked about that, you talked about that. Did you get all these things taken care of? So we keep that communication with the broker and the individuals on the go. What will typically happen in our space, though, is we'll have the borrowers come and see us after the fact, or the people who do the fixing and flipping come and try and get to us directly. We kind of honor the relationship we have with the brokers and just say, you know what, you were dealing with Mike, go talk to Mike. That's his space. He's already got all your information. We're the processor of the paper,
Right.
kind of thing. We don't want to ruin that relationship.
Well, no. And then, I mean, that's the only reason somebody would do that and try to go around the originating broker is just to save the fee, which isn't, I mean, person put all that time and effort, the broker, into creating that relationship, finding them a solution.
Right.
Why wouldn't you want to keep going back?
Well, there's that. And then there's the other side to it is not all brokers have the same relationships with all the lenders, or they may have relationships with particular people at particular institutions where they can get something done where I can't get it done. So that is important for the borrowers to understand that he might be able to take it to institution A where I can't get it approved because he's got a different relationship with somebody at a different branch to be able to get the deal done. And that happens out there.
Right.
Because mortgages are a relationship business. Big time.
Yeah, no, from what you've been saying. So then maybe you can touch a little bit on, I understand that you're doing the mortgage, private mortgages, the proper way, the correct way, but there's a lot of lending that goes on with either an accredited individual or even the whole friends and family thing, or a fix and flipper might go and say, hey, can you lend me 75 grand, 100 grand? That's considered private lending too, is it not?
It is. It is. And so we've run across situations where over the last few years, you've had a lot of people who have money sitting in their RSPs and TFSAs. And what they end up doing is they go to Olympia Trust because they're one of the trust companies out there that allow for you to be able to invest in mortgages through your self-directed RSP. So John goes out, he buys a property for 200 grand. He comes and sees Dennis. Dennis gives him 150. And then he speaks to other people who want to get a rate of return on the extra $50,000. Well, you know what? That's a risk because of what it is that I just said earlier. As soon as that house is bought, everything falls apart and they're relying on the people to build it. It's great that they have a good reputation, but life happens. Like I had the guy who fell off the roof, broke his neck.
Yeah.
Nothing that can happen there. And now all of a sudden his family's got to kick in. He's playing with his retirement funds or his savings funds in order to be able to get his money back.
Or somebody else's.
Or somebody else's funds. And that's not a good space to be in as an investor because I'm relying on everybody else to be able to get that house taken care of, get it finished, and then I'll get my money back. And then the stress levels hit. And then the bad blood hits. And then everybody's banging heads against each other. And then the foreclosures hit.
Well, especially when you're dealing with friends and family, right? Because what I had said was accredited investors. I mean, Securities Commission has defined that because these people have the net worth to recover should something happen. And I think there's something in there that says, I'll paraphrase, they know what they're getting into.
Yes.
When you do the whole friends and family, you're going to convince Aunt Sally to give you $75,000 from her RSP and going through Olympia. I don't know that Aunt Sally knows that she's going in second position, if you're even registering her, behind the
True.
lender.
Yeah. And
So,
if you're using RSP funds, it has to be registered on title.
okay, fair.
There are certain rules that have to be followed. Today, Olympia Trust only allows for up to 90% of an appraised value to be registered on the title. So I can buy a property and get 90% financing if somebody wants to put up the whole 90%. Great deal.
But if they're just doing the down payment portion, I would assume, I don't even know if I've never used Olympia. Are they willing to go into second for that?
Yep.
Whatever. Okay.
Yep, they will. They definitely will. Now, the challenge that Olympia has had over the last little while is you would have a promoter that would go out and say, I'm buying a building for $1 million. I need a lot of money to come in on the RSP side, and I'm going to pay you 10% on your money. And they have to collect, we'll say $250,000 just to be a nice round number. So they'd go up to 10 friends at 25 grand a piece. In the past, you used to be able to do that. Olympia Trust no longer allows that. They want a mortgage administrator, which we're licensed to do.
Right.
One of the few in Manitoba that can. And now they say, no, you have to have an administrator in place to be able to do that. Now then, I'm caught in a pickle. And that pickle is, personally, I don't like 100% financing on private deals. But these people have been convinced it's a really good deal because they can get a really good rate of return. And I understand that if the project is successful, yeah, they've done very, very well. But if something happens to that project, now they're at risk. And they're risking, again, their pensions and savings accounts.
Equity in their house, yeah.
And that kind of hurts. So they asked me for my feedback on this, and I'm going to tell them right up front. I said, I wouldn't recommend this, but it's not my money. You want me to administer it? I will do that. I'm doing one right now where there's a group of people, there's 8 people tied into a $400,000 mortgage on a church in a second position. And I'm sitting back saying, I'll help you with this, but I'll tell you right now, you guys aren't in a good space because you guys are all getting the same kind of rates of return, which is much better. They're at 6.75%. I said, you guys are in not a great situation. But they're doing it for the congregation and the church and so on. And I understand and I respect that. But now they're in a pickle because COVID hit. It was originally set up without a mortgage administrator. Now they're trying to do a deal with Olympia Trust and they can't because they need to have an administrator on side. And lo and behold, we're sitting back saying, okay, well, how are we going to fix this situation? We got to bring all the arrears current and get everybody whole. And try and find a solution in the big picture side of it. So it gets to be kind of interesting, but we have to still assess the risk because we carry errors and omissions. And if we're doing the underwriting, we'll let the investors know. I mean, they waive a letter of indemnity to us, but we have to let them know that, you know what, here's your risk associated with this deal. If there's a non-payment or a foreclosure, there's a potential for a loss. And that loss goes right into your RSPs. I'm not a financial planner, so I can't tell you the true effect of what that loss means within your RSP. I don't know.
It could be catastrophic.
It could be. And I've seen situations where it hasn't been good.
You mentioned that you have a mortgage license and there's not too many individuals that have that, or maybe companies. Can you explain that a little bit? Because I'm assuming most people are like, oh, mortgage professional, mortgage broker, they're licensed. What specifically are you referring to? So
in Manitoba, to be registered or to work in the mortgage broker space through Manitoba Securities Commission, they have 2 different kinds of registrations. One is a restricted mortgage broker, which 95% of the mortgage brokers are. The other one is a registered mortgage broker. The difference being that in a registered mortgage broker situation, we have to have audited statements. All brokers carry errors and omissions. We have to have a bond pledged towards the Securities Commission in the event of something going sideways. And it allows for us to act as a lender or an administrator of private and individual funds.
Okay.
So when we go out and we lend money, underneath the one component, my company is called Advantage Mortgage Center. So Advantage Mortgage Center is the one who goes on as the lender. And when we lend out money, it could be that I've got one investor in a deal. I might have 10 investors in a deal. Nobody knows who each other is because of the Privacy Act unless they talk to each other
Sure.
about going into it. And then that allows for us to act as the administrator on there. So we'll collect the payments, we'll issue instructions, we collect the money from the investors, we have trust agreements with the investors. We will reimburse the payments back to the investors. We're acting just like a bank would. Money comes in, money goes back to them, and then we make sure property taxes are up to speed. Home insurance is up to speed, or insurance is up to speed. We take care of anything that has to go legal. If there's a lien put against property, we act as the intermediary between the investor and the borrower, dealing with all that stuff. Most of the time, what we find is people don't know what it is they're doing when they're lending their own money privately.
Mm-hmm.
With the exception of people like your accredited investor or sophisticated investor, stuff like that, they typically don't know. All they want is a rate of return. They see 10% or 12% or whatever the figure is. Oh, that's great. That's a fantastic return. I can't get that in the market. Yeah, but there's all the other stuff that goes with it.
Security and how do you even
Right.
do that as a private individual, right?
Most of them don't know how.
Yeah.
Some want to learn, but it's not that easy to learn. I mean, I've got 35 years in there, but there's some people who have taken the step. To be a registered broker, it's not easy to set up, and it costs a lot of money to set up. But once you're going, you have to build that rapport and reputation to be able to go move forward with this kind of stuff.
Right. But I mean, to your point, Dennis, you're not going to, if I'm a retired physician with a medical corp, I'm not going to know how to lend out money.
Exactly.
Right. And why would I even bother trying to be registered for myself? Right.
Yep.
And yet I know plenty of, retired doctors that are willing to do that rather than going into an administered fund like yours.
Right. So in our situation, we are approved with Olympia Trust to be able to administer mortgages. I can count on one hand how many people in Manitoba can do it. And I want to say there's probably only 3 or 4 that are active in that space that can do that. Some people just don't want to be bothered with it because it is a pain. You have to know what it is you're doing. You have to know who it is you can talk to over there and how they view things. So I'm going to put a slight note on there. The stupidness that sometimes you have to play with. They're a federally regulated trust company for across Canada. So we just did a mortgage last February 29th. I funded a mortgage where I had to put out money personally because they weren't accepting an appraisal, the value of an appraisal that came across. So somebody bought a brand new house, $614,000. The house is 97.1% complete. I'm hoping their share funds today. I'm told it is. And their hang up has been they want an occupancy permit, which is very difficult to get in Manitoba. They wanted to ensure that the value of the 97.1% has to be identified in the appraisal. And they wanted to get their name associated with the appraisal. Fighting with them to recognize that 97.1% of 614 is still well below the overall amount of money that's being lent out.
Mm-hmm.
They needed to have it in writing, so I had to spend another $125 just to get that taken care of. And like I said, I'm hoping today it's funding.
Wow. There's lots of creativity in there.
There is, and it's making people understand the province of Manitoba is a lot different than Saskatchewan, Alberta, BC, and Ontario. Yeah. Way, way different, but sometimes there's just no way. You have to follow their rules.
Yeah. I love the education component that you have with your clients. I was going to ask you a MIC.
Yes.
What does that stand for?
So MIC stands for a Mortgage Investment Corporation.
Okay.
Mortgage investment corporations have been around, or MICs have been around for probably 50 years, 60 years. And what they are, it's pooled funds lent out to all kinds of different properties with all kinds of different parameters associated with it. So depending on the size of the fund, if you're a $100 million fund, you can have a lot of fun, but you're probably dealing in not only residential, but some commercial, maybe some ag, some industrial or stuff like that. The smaller MICs are typically going to be residential only. There are some that are national, and there are some that are only operating in maybe 1 or 2 provinces or maybe 3 provinces. The big provinces are Alberta, BC, and Ontario. And then we administer 2 small local MICs. Here in Manitoba, I think there's only 3. No, sorry, there's 4 that are located in the province of Manitoba. One of them is not doing much, and then the other 3 are quite active. But they gather funds from all kinds of people, depending on what the offering memorandum says. And it could be as low as $1,000. It could be your sophisticated investor that's going in there. And depending on the setup of the MIC, they might pay out their dividends monthly. They might do it quarterly. They might do it semi-annually or annually. And then typically the investor makes a decision. Am I going to be doing a reinvestment with my dividend that comes in so my fund will grow? My personal fund will grow? Or do I want to have that payout because I'm relying on it for cash flow? But they will all have a board of directors that are going to be set up, and they'll determine very quickly as to the kind of lending that they're going to do. We provide an information circular to the stuff that we do and just say, here's our guidelines. It's 50% residential. We hardly do any ag. But there's lenders out there that'll do that kind of stuff. So it's a matter of educating A, who's lending in the province, and B, who's ready to do the kind of stuff you're looking for and their guidelines. Some of them are really, really tight. Some of them are really strict. And then it still comes down to their availability cash. Like if they've only got $50 million available to them and it's all out, somebody comes in with a deal, well, they can't lend because they don't have the money. Okay. Unless they're waiting for payouts to happen, then they can turn around and commit.
So somebody goes to somebody who could administer a MIC and say, I've got $10,000 that I want to invest into your fund. What is my ROI, my return on my investment?
They'll typically tell you, and they'll have a track record of it. Most of the ones that are operating on a national basis are high single digits. When you see stuff that's going to be a little bit more than that, the higher the rate of return that's going back to the investor, the higher the risk of the kind of lending that's taken place. So that's the kind of guide that they have to use. For the most part, a MIC will give you a return that'll be higher than what you can get in a GIC. Everything they do has to be secured by real estate. No ifs, ands, or buts. So it's not just hoping that they're going to lend out to an unsecured loan kind of thing.
Right.
It has to be secured by real estate.
And that's like a regulation?
That's a regulation that's in place.
Oh, okay.
So the other neat thing about a MIC is they have to give away all their net profit. A MIC will not pay income tax. So whatever that net profit is, if you've got a gross income of $1 million and the management fees are $100,000 and there's $900,000 left for net profit, that's what would get distributed to all the investors. So they don't pay income tax. And it's been like that since these things were started way back when.
Wow.
So it's kind of neat that way. And it makes it kind of fun when we're administering the stuff, because who's going to do what?
Well, yeah. I mean, obviously you have to get paid for your work, but I guess that's not, there's no money left in the corp. Those are just whatever service fees for the deal or.
Right. I mean, I can tell you right now, most of the people that are running the MICs, the larger MICs, they'll have some salaries. They'll have their computer programs for administration, a little bit of legal work associated with it. They're very profitable, very, very profitable, but it still comes down to what it is they're doing. Like there's one of the biggest ones in BC is called FizGuard. They've been in place for, I think, 50 years. It's the second generation that's kicking in with it right now. Their fund is about $250 million. They do extremely well, but they also take a look because they lend across Canada.
Sure.
And they look at the markets. Sometimes they won't lend in particular markets, or they won't lend second mortgages, or they're just very picky on what they do. And I think their overall rate of return is around 7 or 8%.
So I've been approached, and I've been to real estate conferences where you see some people in the trade booths saying that, I'm assuming those are mixed then, because they're like, okay, we're investing in the Niagara region in Ontario or whatnot. We've got these 3 buildings, and you have to be in for about 5 years because they have to actually be built and sold in order for you to get your other money out. Is that a MIC, or is that something?
No, that wouldn't be that would be different. A MIC typically doesn't get involved with something like that.
Okay.
There was a company, and I won't mention the company. It was a company out of Ontario that was involved with a project downtown Winnipeg where the tallest building was supposed to go up. So what they did is they gathered a bunch of investors to go in on a different phase, which was the first phase, to go in and buy the land. And then they did some pre-sales for I think it was supposed to be like a 50-story building or something. They started collecting deposits on all of that. And because they did this in stages and phases, a MIC wouldn't do that kind of stuff. To my knowledge, I haven't seen a MIC do that yet. But what they did is they gathered some funds. The project failed. The investors who were buying units, as I understand it, got all their money back. The investors in the first phase are the ones that are going to take a loss because they got to do something with the land. And I say a loss for the amount of money that they won't get back had they had been paid all of their interest over that time.
Right.
They may get their principal back, which is still a saving grace because, the value of land downtown Winnipeg is still good. So they may get that back depending on what it's going to cost for legal fees and everything else.
Okay. We've been speaking about a MIC, but we also previously to that, we're speaking about private mortgage lending. So I now understanding that the two are completely different. Who are you representing when you're lending out private funds?
So my office is quite fortunate in having the ability to have the ability to administer two MICs, and then we administer the trust. And I call the trust the private lending side because when people want to go into a deal, they say, yeah, okay, I want to do this. Dennis, take care of it for me. So I've got some investors that say, I like that building on Pembina Highway. I think the value is $1 million. The guy needs 600,000. I'll take the full 600. Just take care of the paperwork for me.
Okay.
So there are some people out there who are quite sophisticated and they run forward with that. Other times that borrower would approach us and we'll say, okay, well, we've got to gather $600,000. Who do we know in our back pocket that likes going into that kind of a property?
Okay.
And what kind of money do they want to put in? Most of our investors are 25,000 plus. We get the very, very odd one because, it's work to do it with,
sure.
Whether it's a 10,000
Mm-hmm.
or 100,000. But the more 10,000s you have, it's a lot more work. Most of our investors are in that $25,000 to $50,000 range. And they just know, yeah, I'm spreading my risk. It's going over there. They like the project. It's interesting when we're dealing with some of these guys because a lot of it is trust and experience that we've had with them over all the years. And others will do their background search.
Okay.
Yeah, and we encourage it. We tell everybody, go look at the property. Don't be afraid to look at it. So I've had a couple of investors that have said to me, well, I did a King's Bench search and this guy appears to have a criminal record and not looking good. And then we go through the deal and I follow it up because typically we do the Google search and the KB search. And then we find out the explanations behind it. And then there's times you got to phone the people and say, well, what's this all about?
Mm-hmm.
We didn't know anything about it.
Right.
Or we phone the broker and say the same thing. And in a couple of cases, some of the research they did was incorrect or it had to be rectified or there was something in place. and it's interesting when you've got that kind of a person that's going out because it keeps you on guard, but it keeps you on guard not only for them, but for everybody. So that when you get challenged on something or you get asked a question on something, then at least you can answer it properly. I don't like lying because I don't lie. You'll always remember the truth. And when somebody comes at you with something, at least you know what the answer is. So it's easier to get around that.
Yeah. So, I just want to solidify this for myself, but also for the audience. So let's say that you have a fix and flipper that approaches you
Mm-hmm.
and you've worked with them before and they're like, okay, Dennis, I just bought a really sweet deal in River Heights, 350 grand. I want to put 100 grand into it. So now I'm at 450 and it's going to sell for 550. Okay. What are you doing with that deal then with your private?
So
people?
our typical approach on something like that would be, we want to see the offer. If it's MLS, great. Sometimes they're back pocket. We want to take a look at what kind of renovations are going into a place and if they make sense. And then the end valuation. So we'll ask the appraiser and we'll say, here's what's being bought. Here's what they want to, here's a copy of the work they want to get done. And we're going to have that appraiser go in and do some inspections. to make sure that everything is there as quality. And typically we'll go in and do at least one inspection. So we'll tell them, okay, here's your pricing. It's going to be, we'll do 75% of the purchase price, 75% of the renos, because again, I want them to have some skin in the game.
Sure.
We register for that full amount. We'll advance the purchase, or sometimes we'll advance the whole amount into the lawyer's account, release for the purchase, and then release the rest as time goes by. And then when it comes time to the work being finished and they're putting it on the market, typically, if it's going to take 6 months or longer, the mortgage is usually open after that. So they don't have to worry about having any 3-month interest penalty.
Okay.
And then they just pay us out. The odd time we'll go one step further, because you and I both know a lot of agents that are selling these kinds of houses. You make that call and say, does this make sense?
Right.
Like, is this a realistic price? And it's a way for us to check on what the appraisers are going to tell us. Some appraisers are okay. Some are really good, and some, they think that there's a lot of sky out there.
Well, at the end of the day, it has to sell.
It has to sell. So yesterday I get a phone call from somebody. They built a house, oddly enough, in River Heights. They've had this house on the market since September, which kind of surprised me. And there's 2 mortgages in place. One's at 8%, the other one's at 12%, for a total amount of $510 outstanding. And they need $230,000 to replace the second mortgage that's in place, because they're calling it. The house isn't sold. Wow. In River Heights, and it's listed for $840. They dropped it down to $830. There's got to be something wrong with the house if it's not selling that quick over that period of time in River Heights. I don't know what it is. But in a case like that, we still know that if we're lending money in a second position or doing a brand new first, at a $510,000 exposure, even $550,000 exposure, there's still lots of room to move.
Sure.
And if we had to go through the foreclosure route all the way through, it would probably take us about 6 to 9 months. And then we're the ones selling it realistically, and we'd come out whole.
So on the other side, so you explained what happens on, let's say I'm the investor, the fix and flipper. On your investor side, are you going, hey, John, hey, Frank, hey, Steve, I've got a deal in River Heights. Are you interested? The person's asking for this, this, and this. Here's the project details. Is that kind of how
that's pretty much how it is. There's some people who have told us that they want to be into a deal for a year. They want their money out. So we got to be quite selective and be very comfortable that that deal is going to likely end up paying out within the month. Because if we don't, then it causes grief and aggravation. Somebody's got to step in to replace those investors, because you just can't openly go and call the loan.
Right.
And we're
so
kind
you
of
have
stuck.
to have some backup then.
We have to have some backup.
I never even thought about that part of it. Because,
we have to have some backup.
Also, life happens on that side too.
Yes, it does. And then some people, when they get paid out, because they've had such a successful track record of payments going back to them, they get paid out today. They want to be in something tomorrow.
Right.
Because
they want that turnaround. Sure.
So sometimes we end up flipping them into some of these newer deals.
Okay.
And they're okay with it. So it works good most of the time. The other time we got to scramble a bit.
So if you have a fix and flipper and you're lending 75 LTV, at 25% you've said it several times during the podcast, I want them to have skin in the game.
Yeah.
Are you comfortable with them going to Aunt Sally and getting an RSP, something or other for, like, do you care where that money's coming from?
As a lender, I'm in first position.
Right.
I call the shots. So if Aunt Sally goes behind, it's going to be Aunt Sally will get notification if something goes wrong. And then there's a conversation to be had.
Right.
Aunt Sally, do you want to do this? Yes or no? Because if you don't, you could lose all your equity in here. Now you got to start talking to somebody to help this situation out.
Yeah, interesting.
Like, I've had situations where I've had second mortgages behind me where they've bought me out. They've taken an assignment of my mortgage, and now they're completely in first position, and they control the whole thing.
Yeah.
And that's their safeguard. When I go into a second position, that's kind of what it is that I have to play with. Kind of like the deal we're talking about, where Scotia's in front of me. The guy was to make the payments to Scotia. We brought it current, and we're foreclosing on the other side. The only way out for him is selling the property. And we've got good equity in the property, but unfortunately, it's in a bad spot.
Well, and speak to me about second position, because a lot of people are like, okay, well, the dollars are still okay. I've been told by a lot of lenders, second position gets eaten up by a lot of fees.
It could get eaten up by a lot of fees, and we're subject to market, and depending on your overall loan to value.
Yeah.
So if
And
I'm
the condition of the property at the time.
Yes, very much. So if you've got a property in a good area and you're in a second position and you got a good loan to value, say at 65, 70, 75%, you should be okay. Typically, we make sure that the property taxes are paid, the mortgage payments are current. You want to know what kind of mortgage is in first place, because this one that I just mentioned with Scotia in the front, the mortgage on the first rate, or the rate on the first mortgage, is 4.49%. If it was 10%, now you've got to start thinking a little bit differently, because every time I make a payment, my end starts going up and theirs isn't moving. So we got to really watch the second mortgage market when we do this kind of stuff. We have been doing quite a few lately. And the reason behind that is because people are still on that 2% first mortgage rate situation for another year or 2 years.
Yeah.
So the next little while, we're going to start getting a little bit more cautious, because we know that if a mortgage comes up in a year or two, will they be able to afford to make those payments?
Yeah.
Reality has to kick in.
Well, yeah. I mean, it's happening now.
Oh, yeah.
I mean, we're here. Before we end, I just want to circle back and kind of summarize things, because we started off by talking about mortgage brokers. I really like what you said, in that a broker is going to be able to assess the client and then put them where they think they're going to be. And that is based on things like credit, credibility, experience,
jobs, age, family. Like, there's all kinds of things that a good mortgage broker will ask. And that is where you are today and where do you think you're going to be tomorrow? We don't have crystal balls to say the interest rates are going to go down or go up or stay the same. We listen to the economists and we guide ourselves by the economists. Nobody would have ever predicted COVID.
No.
Nobody. So rates staying as low as they did for as long as they did was a big, big plus. If COVID never happened, where would rates be today? I don't know. Nobody knows. So that's a hard one. But as an example, when somebody comes in, you ask them, what are you paying today? What kind of bills do you have? Are you going to be looking to upsize? Are you going to be looking to downsize? If you are, when is that going to happen? Do you think you're going to be getting a lump sum of money that's coming in the form of a gift from parents, or a death from grandma dying, you're getting an inheritance? How do you want to apply those funds to your mortgage? Do you want to keep that up? Like, these are all questions that need to be asked. Do you plan on living in this house for 5 years, or do you plan on living in it for 1 year?
Long term, what's your exit plan?
Right. Like, there's something, and I don't remember where I read this, but there was a stat way back when, like 40, 50 years ago, people would change houses every 3 to 5 years.
Yeah.
Now they're holding on to the houses a lot longer, and I'm told it's 5 to 7 years.
Oh, okay.
So do people want to stay into their house that period of time, or are they going to leave? 40 years ago, divorces weren't at 64% like they are today. So now mortgages are going to be broken. When they break, what kind of penalty is going to be associated with it? It's interesting, when I have people coming in to see me, first-time home buyers, I ask them 3 questions, or I tell them a situation for 3 situations that take place. You guys are going to get married. You're going to buy this house, live in it. You'll have 2 incomes going into it. Fantastic deal. Option number 1. Option number 2. You're a young family, you're a young couple, you're going to have a family, you're going to go down to 1 income. You might want to do some renovations to the house. You might be stretched on income. What are you going to do? And then the third one that's going to kick in, you're not going to like me for saying this, there's a very strong chance that you guys are not going to be together within the next 5 years. So if that's going to happen, we got to take a look at the prepayment penalties as it would apply to the mortgage that you select. And they can look at you all kind of flustered, but then they understand it when you say it, that this could cost you this versus that. A lot of people still tend to listen to what mom and dad had in their years. Oh, it's just a 3-month interest penalty. Well, unfortunately, that's not the truth anymore. Today, it's the greater of a 3-month penalty or an interest rate differential. So the people who had the 2-year or 2% interest rates 3 years ago are sitting very pretty, because they don't have to worry about interest rate differentials. The people who took out mortgages last fall are sitting at 6.5%, And if they want to go into a new mortgage and they have to break that mortgage, they're talking about a heavy penalty because that penalty spread is probably 2% a year right now
Right.
for the balance of the term. That could be pretty heavy. And that nobody will educate them on them. They'll blame everybody because they weren't informed of the process. So a lot of brokers are starting to pick up on that part of the education side. A first-time home buyer, if they sit down with somebody for at least an hour, they will feel comfortable knowing that they've been asked or they've been told a lot of the information that's there. And the difference between a broker and somebody working at the bank, the broker will take the time to explain that to them. Not all bank specialists will do that because they just want to rotate people in and out. That's all they want to do. And if they can only spend 20 minutes with somebody or a half hour with somebody, that customer isn't getting the best information that's available to them.
Well, not only that, what you said there is, again, husband and wife come to a mortgage broker and, okay, I want to buy this. I want to pay this for interest rate.
Right.
And after you pull the credit, you look at the situation and one stated income and one is on mat leave or whatever. It's like, no, if you really want to do this, you need to go B lender. Maybe we'll do C for, a year until this life situation changes.
Right.
I like that.
And the life situation is a real big thing for people. They don't take that into consideration. They've been renting for a few years. They've started to grow their family. Their family's getting older. Well, one kid's going to go. And in another couple of years, another kid's going to go. So is this house going to be too big for you? Are you thinking of this is going to be a long-term purchase? Many people just never think that way. We think we're in our house for a long time, but more often than not, you listen to the stats, people are flipping out quite a bit. So it gets to be kind of interesting, and you get to know what the people are like. And when you educate them, they'll always come knocking on your door. And on the broker side of it, it's always nice to have that because, hey, Dennis did a good job of telling me this. I'm going to tell my friend, I'm going to tell their friend, and that kind of stuff. So it helps with the growth of our industry.
Wow. Okay. Final thought, second last final thought. Real estate investor.
Yes.
Either a fix and flipper or a BRRRR person, buy and hold. What is your best advice for them to, before they approach private lending, to be successful?
They probably need a really good handle on what the real estate market is looking like moving forward. And I'm going to toot you a little bit here too. They need to know and understand what's involved with the rules relating to rentals. They need to understand what's involved with property management because not everybody is a good property manager. And they don't understand. They think they can get away with it, but they can't. I know you and I have had conversations, and again, thank you very much for some of the stuff you provided. But these are things that most people just don't know. They think they can get away with something, but they can't. If you're hoping that the market is going to move forward in a great space because the market's going to continue to rise, which I personally believe it will, that's good, but where's the property located? Are you buying in the red zone? Are you buying in the south end of the city, which has got a lot of rentals that are there for university people? You really got to get a good handle. Associate yourself with somebody who's a very experienced real estate agent because they usually have a really good handle on that kind of stuff. Somebody who's been around for a while or who's eager to learn the business. I don't like taking away from the newbies because they got to learn too. There's some newbies that will be around for years and years. They just need that process to learn this stuff. Those I find are the big ones. And then understanding what you can afford to pay versus what it is you're going to have for income coming in. And is it realistic? Because more often than not, they think they can get $1,800 a month and they can only get $1,200 a month and it's costing $1,400 a month. Like they got to put a lot of thought process into it. And then the stuff, be ready for the surprises because the BRRRRs and the flippers, they think it's 10,000 to fix, and next thing you know, it's 15 because they didn't know this or they didn't know that.
Or they found knob and tube in the attic.
Right.
Another 10 grand. Boom.
Yep. Yeah. So be ready for the surprises and budget for it. A lot of people don't budget for it. And then the other big thing on the budget that has to be said, never forget the taxes.
Yeah.
GST, PST. If you're spending 100 grand, you know what? It could be another $5,000 to $12,000 that you didn't budget for, and now all of a sudden you're out.
Yeah.
That can hurt.
And if you don't do your underwriting and your numbers properly, and you add all those things in, at the end of the day, they're like, well, this deal doesn't make sense.
Right.
Right. It doesn't. You shouldn't have gone into it.
Right.
Right.
Yeah.
I mean, that's not your fault.
Exactly. You know? And if they can, one of the other big things that I like is having availability to credit. There's a lot of people that say, "Oh no, I don't want to carry an extra credit card." You know what? Just have it. I've
you need
always
to bridge yourself all the time.
You do. There's some people that I've told in the past. Like I know one guy who's got $500,000 of unsecured credit available to him. He says, "I might use 50,000," and he says, "It all gets back to what you told me many, many years ago." And I said, "What's that?" He says, "The Emergency Opportunity Fund. If I had to run down to the Mayo Center to take care of my kids," and he was self-employed, "I don't want to have to worry about trying to go beg, borrow, and steal at banks, family, and anything like that. I just use a credit card, it's paid for, and I'll worry about it later on." Or if an opportunity came up for me to buy a property where I can buy it for 200, I see the opportunity to put in 30, 40, 50,000, I can sell it for 350. I don't have to go beg, borrow, and steal to do that. So he said, I just keep that credit available. If they're lines of credit, I'll use them once a year, twice a year. If they're credit cards, I'll go fill up with gas once every 6 months and then just hide the card.
Yeah.
And that's a really, really big thing when people are doing this kind of stuff, because now all of a sudden, depending on the kind of interest rates that are associated with it and how quickly you pay it off, even those 18 to 20% cards could still do you a lot of good rather than having to come into the private route to do something, because you've got it available to you. And then you just pay it off after you do the refi.
Well, to your point, I mentioned bridging yourself. What I'm referring to is a lot of people who are just getting into this will say, okay, you're lending me 75% of my $100,000 renovations.
Right.
Well, when I want to pay my plumber $8,000, guess what? I'm only getting back $7,500.
Right.
That $2,500 has to come from my pocket. Correct. And a lot of people don't realize that. So now they're constantly short, and then they're doing that rob Peter to pay Paul thing.
Yes.
Where they're taking all of this, they're going to hit the wall at some point.
Mm-hmm.
And the other thing is, when you've got a project that's, and this is mainly advice, you know this already, but I'm saying this for the benefit of our audience. You've got timing issues sometimes, right? And
huge.
You know, let's say that you managed to get the roof done, and that's the only thing, but you're still waiting, like I am, for a permit. Well, the roofer wants to get paid. Do you really want to pay the lending fee for that inspection and the lawyer fee for doing all this stuff and giving you a check for one vendor? Or is it better just to take that 10 grand from your credit line or whatever it is for the next few weeks until the next phase is done, so you can get a larger progress payment in, right, and pay less fees, because it all costs money?
Yeah, it definitely does. And that's a very good point, because a lot of people just never think of that. Even whether they're beginners or people who've been doing it, they're on their 10th one, the hiccups happen.
Yeah.
Because they thought they knew it and they don't, unfortunately. Or they get surprised. Like,
well, it's school of hard knocks, right?
Yeah. And the permits have always been an issue. I heard the other day that they're going to lighten up on some of the permits here in the city of Winnipeg for some small stuff, but let's see.
I'm openly laughing, but we'll see. Yeah, the bane of my existence. All right. Well, this has been a pleasure. I always end the podcast by asking one question. And that is, this is the Investing to Win podcast. How do you define success, and what does winning look like for you?
How do I define success? Success for me comes when a project has achieved to its potential for the dream that you were looking for. What was the second question?
What does winning look like for you personally?
Winning? I'm typically a happy guy, and I'm usually a very positive thinker. I'm blunt, but I typically try and be as straightforward as I can with people, and seeing people's success is a great thing. And I see a lot of people's success both on the investor side and on the borrower side, because they're never afraid to say, Dennis, we want to rack your brain for a little bit. We'll buy you dinner or buy you lunch or something. Or breakfast, whatever. They'll say, we need to rack your brain on this and rack your brain on that. And then you see that conversation evolve and move forward. And then you see the success that comes out of it.
Well, that's wonderful. Thank you so much for hanging out with me. I learned a ton. And, this exposing, educating about what you do and the differences is just mind blowing. So thank you
Good.
again.
Thanks for having me out. I really appreciate it.
All right. Take care.
You bet.